Jetzt geht. Eins links, zwei in der Mitte, drei hinten. Alles links. Das geht um die Ringe. Das ist eins. Das ist so links. Zwei. Dann sehen wir das nämlich nicht.
Ich muss direkt zwei nehmen. Kommt gerade noch auf den Weg.
Guten Tag.
Good afternoon, ladies and gentlemen, and welcome to Deutsche Bundesbank. We're here to present the Financial Stability Review. It will be presented by Ms. Claudia Buch, Deputy President of Deutsche Bundesbank, responsible for financial stability, and Dr. Andreas Dombret, member of the Executive Board of Deutsche Bundesbank, who is responsible for banking supervision.
Thank you, Mr. Best. Ladies and gentlemen, I'd like to welcome you very cordially to the 10th Financial Stability Review of the Deutsche Bundesbank. For me, it's the second time. If you look back to last 10 years, well, that takes us back to the speech given by Raghuraja. Maybe you've seen him when he was here in Frankfurt 10 years ago. He was professor at the University of Chicago. Today, he's the governor of the Indian Central Bank. So 10 years ago, Jackson Hole asked the following question: has financial development made the world riskier? Well, and he warned against the risk of too low interest rates that would imply risks for financial stability. Now you might say today's situation is somewhat similar to the situation 10 years ago. We have very low interest rates, low risk premiums in the markets, but we also have a different environment. We have a different framework, a new regulatory framework. We can counter systemic risks in a better fashion. So the parallel cannot be completely drawn. I'd like to start with that before we start with the precise details of the review, and like to talk about what we use or what terms we use when we look into financial stability. Financial stability, for us, generally speaking, means the ability of the financial system to fulfill its central economic functions and to make sure that volatilities in the financial markets does not or will not affect the overall economic situation, above all at times of crisis and distress. And if you look back 1 year, we talked about many different risks that might materialize possibly. Last year, there were 2 stress phases or phases of stress. The lengthy discussion regarding Greece's future within the euro area in the summer, and the volatility in emerging markets and the economic outlook in China. So there were 2 phases of stress, and the financial system responded in quite an acceptable way. That is in part also thanks to stricter regulations which have been implied over the past 10 years. Banks, to just one example, are better capitalized than before the crisis. So we see the outcome of regulations too, but that doesn't imply that the macroprudential securing and the maintenance of stability can be neglected. No way. We have created a new field of policy that goes beyond macroprudential regulations. Macroprudential regulation aims at securing the stability of individual institutes. We've supplemented it with a systemic perspective, which is influenced by different factors. So first of all, it depends on the size of the players in the financial market. That's too big to fail, which is quite often quoted. But netting or connected to fail, that's another aspect. And also the exposure to similar risks, that might lead to a systemic risk, so too many to fail. So macroprudential monitoring has to consider all these different aspects to guarantee the stability of the system at large, and also to guarantee sufficient resilience. So against this backdrop, let me summarize the current situation of the German financial sector as shown in the core statements of our review. And then we are going to look into each of the aspects in greater detail. First of all, low interest rates. I've mentioned that before, that these bear risks for financial stability. Also, a change might imply additional risks because then the banks would be faced with lower profitabilities, and for insurers too. If interest rates increase, the resilience might be questioned. And quite generally speaking, we can see right now that the low interest rates affect the profitability both of banks and insurers. We have initiated a lot of regulations both for banks and insurers, and the question always is, are there incentives to divert to the unregulated market? That is why we focus very much on the German shadow banking sector. The German shadow banking sector has grown in volumes but there are also valuation effects. Right now, there are no increased risks to be seen, but I'm going to talk about that in greater detail. We have also a list of macroprudential instruments that have become available and that can be used to counter risks. And at the end, I'm going to comment briefly on the European Capital Markets Union, which is an important supplement to the banking union, especially because it can help to strengthen the markets for capital and to provide better mechanisms to handle risks. So let me begin with the low interest rates and financial stability. That's always linked to the monetary environment. But if you look at this graph, you can see that growth rates are shown here. Low interests also reflect poor economic growth. And we have to bear both of these aspects in our mind if we want to assess and interpret the current situations and also address systemic risks. Clearly, low interest rates, above all when they prevail for a longer time, offer an incentive to look for higher yield bonds, and that this might incur risk if the risk premiums are not high enough and the risks are not properly reflected. Now you might say, well, in the midterm there might be a trade-off between expansionary monetary policy and financial stability, but we have to prevent this at all costs, because if normalizations measures should be required, we mustn't be led into a situation where we couldn't take these measures because of financial stability. That is why it is so important to look at the risks that build up, to monitor them. The individual institutions have to look at these risks, have to adopt their policies to that. And as supervisors, we also have to think about the regulatory requirements. So it's a bundle of aspects which we have to consider. Let me address the German bank sector and start with a graph, a table shown here. I'm going to show this once again later. Here you see the connectedness in the German financial system. You can see on the one hand the position of the creditor, that's the first line, and the private households. And the size of the circle shows the relevance of the connectedness between the different market participants compared to the German gross domestic product. It shows the size, but also the interconnectedness, because that's relevant for the stability too. And this red circle you can see here, that's the connection between banks or amongst banks. So in the financial sector, you can see that the banks are closely connected. That's an important aspect for financial stability. And that is why Mr. Dombret will talk about this in greater detail later on. Well, I'm going to talk about the shadow banks and the insurers. If you look at the first column of private households, you can see that private households are greatly invested in banks, but also with insurance companies. So we looked in great detail into the insurance sector. Insurers have a different business model. They fulfill a different function in the financial system, which basically has a stabilizing effect because there are different investment streams, but the insurers, due to the low interest environment, come under pressure as regards their earning situations. The Life Insurance Reform Act of last year has tackled these problems. It has increased the resilience of the insurance companies. The valuation reserves are now kept. There is less payout to the policyholders, so there is more resilience as a result. However, there are some exclusions, internal profit and loss transfer agreements. So some of the companies have used this loophole, as it were, to transfer profits to the mother company. Then we also looked, and I think we did this last year too, how strong these legal changes impact the stability of the insurers. Does it solve all the problems that might occur? And this graph shows, we looked at different scenarios that there are still risks. You can see how the requirements of insurers would develop across time following different interest scenarios. I'd like to focus on the red scenario. That's the worst case, as it were, that might occur. In that case, the interest rates on government bond as a benchmark would remain at the current low level, and also the excess returns the insurers can make on the market would remain at an extreme low level. So this is a true worst case scenario which we have combined here. But you can see that in that case, many insurers would no longer have an adequate equity base as required by the regulation. But the scenario also shows that there's still time for adaptations, because that scenario would only build up over a longer period of time, that's 10 years. So it shows at the same time that adaptations are required. I have briefly mentioned that we also looked at an extreme scenario affecting the insurers, and that is due to the fact that we have fixed surrender values for some years. That might mean that in an extreme case, should the interest rates raise extremely, the policyholders would cancel their contracts and would withdraw their money. And it's similar to the banks. There's a bigger risk with banks too, but with insurers, this might lead to a run, as it were, on the policies. And that is due to the fact that the surrender values are not linked to the market values. So this is an aspect driven by regulatory aspects. And as of next year, with Solvency II, we have a new situation as regards the regulation of insurance companies. We'll have greater transparency regarding the risks in the balance sheets. That's a positive development from a macroprudential view. If you look at the entire system, however, we have to bear in mind, or we have to consider, if pro-cyclical effects might occur, so that insurers will be mainly driven by market evaluations. That is something we have to monitor when we implement this new regulation. More regulation, which has a stabilizing effect, also implies a risk. There might be evasion movements, and that brings me to the shadow banking sector, or expansion of the shadow banking sector. That's the catchphrase that crops up. Well, first of all, I'd like to say shadow banks. That sounds somewhat misleading. It sounds like that these shadow banks would offer shady business, but that's by no means the case. Neutrally speaking, these are financial intermediaries like banks or insurances. They offer financial service in the market. They offer financing solutions, or you can spread your risk, for instance, when you mutual funds. And similar to banks or other institutions, these shadow banks might pose a risk, and that is why they're regulated. So in this debate, you have to always bear this in mind. Shadow banks are regulated, and we've looked at these risks in our monitoring system, and we monitor them. Why is the shadow banking sector growing? I'm going to show a slide of that later on. Well, first of all, tighter regulation of the banking sector. I've mentioned that. Many of these new financial intermediaries are linked to technical progress, and there are positive aspects involved here because new business models emerge. And to a large extent, it's simply true that if you look at the increase since the crisis, it's about valuation effects. So that is why you have to really look closely and distinguish this from the regrouping of portfolios. As regards the risks posed by shadow banks, well, we have the same categories as in the case of banks. Maturity and liquidity transformation is one important aspect, which might mean that the run situations might occur. There is a slightly increasing trend to be observed. If you look at other indicators for risks in the shadow banks, well, the trend is decreasing. That refers to the use of debt and also the type of bank-like business that is being carried out, and also the connectedness with banks. Now, the German shadow banking sector, Well, in that case, the mutual funds are the most relevant player here. They have increased their volumes. It's not an unregulated market. We have a capital investment code that deals with these aspects that are driven by the mutual fund sector. And if you look at this, you see a clear increase. The dominating part of this increase are valuation effects. If you look at the very bottom, this little red line, well, that's securitizations. But securitizations, which caused the financial crisis, it's very complex products. There is a downturn here, both in Germany as well as abroad. Now back to the chart I've shown before. Now I'm focusing on something else, not on the connectedness between the banks, but the relevance of the mutual funds. And you can see that there are links to the remaining financial markets, and that is exactly what we're focusing on. We want to see if there are any contagious effects here. And I'd like to talk about why we are focusing on banks and insurers, because that's the dominating part of the German financial system. Let me also briefly talk about the instruments which we have at our hands right now, which we already have or which will be available as of the next year or the years to come. If you look at the first column, why do we use these tools? You can see exactly the reasons I've just mentioned. We focus on systemic risk, the size, too big to fail. We have additional capital surcharges for systemic relevant banks. We have new recovery and resolution mechanisms, and now we also have clear criteria for TLAC, total loss absorbing capacity. That's all the loss absorption capacity for global systemically relevant banks. So the objective being is, should a large systemic relevant bank come into distress, we want to reduce the likelihood of such an event and use private funds to handle that and take recourse to public funds. Then limitation of pro-cyclical effects. Many banks are subject to the same macroeconomic effects, and as of January 2016, we could use the counter-cyclical capital buffer. Because that's what I'm saying, because right now there is no need to use this buffer. So we have an additional capital buffer. We could request them from the institutions if credits would increase, but that's not the case currently if you look at the German data. And the last aspect, the last point here, is also linked to the topic of exposure to similar risks. Risks from loans to or mortgage loans. Our basic assessment is that currently we have high price increases in the individual market segment, but there are no indications that there is an excessive real estate price boom. This basic assessment hasn't changed compared to the previous year. We don't see excessive growth of credit lending, of real estate financing. But quite often we've seen in financial crises that the real estate sector triggers crises. So we have to be prepared for any changes. And there are two dimensions. At the beginning, we have to have the macroprudential instruments to take action. And at the same time, we need better data. I'm not saying this because the Bundesbank likes to produce statistical data, and you might think that we'd like to have more data for the sake of it, but no, that's not true. We don't have proper information about the total volume. We know hardly anything about the credit conditions, about the actual prices, and that's exactly the information you need to take preventive action. Now, the last item, which takes me to the European level. This graph shows how cross-border capital flows and finance flows, what they looked like before the crisis, and what you can clearly see if you look at the different columns here, 2008 and 2009, they have a lot of debt financing. Cross-border finance was mainly driven by debt. So capital flows were much lower, but you can see much more stable across the crisis. So there was a swift reverse of capital flows. That's exactly the crisis we have observed, and it was mainly driven by debt flows. Why am I showing this chart? Well, this is linked to the fact of how we evaluate the European Capital Markets Union. This Capital Markets Union is a rather comprehensive term which is interpreted in a very different way, but the Capital Markets Union for us is the key for us to think about where in the existing systems there are misincentives, frictions that prevent a proper financing structure between debt and equity. That doesn't imply, that we don't accept debt. It's an important factor for finance. But the question is, where are distortions when it comes to the financing of companies that prevent a well-balanced mix of equity and debt? Because equity, different from debt, has the benefit that risks are better balanced. Because if we have an equity finance, you're not promising a proper payback. You actually cover risks in the financing structure. And that is why we think that we could have a double dividend if we'd have proper reforms in this sector. The Capital Market Union could thus provide a double dividend in the form of more growth and a more stable financial system. If you look at the venture capital financing, that is an important aspect in the European sector and is still under development. I'll leave the details for discussion. I'd like to hand over to Mr. Dombret, and he's going to be more specific and talk about the German banking sector. Thank you very much for your attention.
Ladies and gentlemen, I would like to extend a cordial welcome to all of you here at Bundesbank 2. It's nice to have you here in such large numbers. Could I just have the points, please? I'm here to talk about the risk situation in the German banking sector, as announced. But before I do that, I would like to briefly take stock of the first year of European banking supervision and to go through the most important points. As you know, on the 4th of November 2014, the ECB assumed direct supervision of the approximately 120 major banks in the euro area. Amongst these, there were 21 German institutions at the beginning. In the meantime, the number has risen to 22. Considering the size of the project of the European banking supervision and the short time to prepare for it, many back then doubted that a European banking supervision could work. I must admit that I wasn't one of those, but it's something that I heard quite frequently. After 1 year of European banking supervision, my answer is yes, joint European banking supervision works, and I am confident that it will continue to match high expectations. Cooperation between the ECB and national supervisory bodies works well. In Germany, these bodies are Deutsche Bundesbank and the Federal Financial Supervisory Authority, BaFin. And what I think is the best aspect is that we do indeed observe a gradual Europeanization of banking supervision. Thus, I'm satisfied with the first year of European banking supervision. Of course, there are still a few things which need improving, and after just 1 year, it would surprise us if there wasn't anything to improve upon. When it comes to the things that need improving, I have to quote the decisional structures and processes. In my opinion, we don't yet distinguish sufficiently between important processes on the one hand and routine decisions on the other hand. Nevertheless, far be it from me to express general criticism concerning the work of the ECB. Naturally, European banking supervision has also changed things for the banks themselves. Communicating with a banking supervisor increasingly takes place in English these days. Cross-comparisons between banks at an international level are attributed a higher importance compared to the past, and supervision per se has all in all assumed a more quantitative approach. All this has, of course, increased the workload of banks also for Deutsche Bundesbank, but ultimately the banks too will benefit from a better supervision and a union-wide level playing field. With a view to the future, there is currently an ongoing debate concerning deposit guarantees. Yesterday, the EU Commission tabled a plan to this effect. I see this project in a very critical light, as I believe that we currently still don't have the necessary preconditions for European deposit guarantee system. We have a single currency and we have a European supervision, banking supervision, as I've just mentioned, but to a very high degree, it is still the national financial and economic policies that shape the conditions of the banking system. One example of this is the insolvency law for enterprises and consumers, which differs greatly within Europe. That is a fact. And against this backdrop, a single deposit guarantee system would force the consequences of wrong national policies on all savers in the euro area. And there is something else. As long as banks still hold many sovereign bonds of their own country within their balance sheets, a single deposit guarantee system would lead to a communitization of public debt, thus introducing Eurobonds through the back door. Independently from all this, we could also ask the question whether the Single Resolution Board SRB, as presented by the European Commission yesterday, is the right vehicle for a European deposit guarantee system. And last but not least, as we believe the proportionality of regulations would have to be safeguarded. That is, the burden between large and small banks would have to be distributed adequately. These are points which we find very important, but now back to the future. The first year of European banking supervision went well, and a working banking supervision, of course, also requires a regulatory basis. As far as regulations go, we have 7 years of reforms behind us. The reform agenda of the Basel Committee has, to a large degree, been implemented. Thus, before thinking about future regulatory projects, we should first observe the effect of the new regulations, considering each regulation individually and in connection with the others. Regulations and supervision are not the only challenge for banks, neither are they the largest one. Let's have a look at the risk situation in the German banking sector. And first, let's have a look at resilience. As far as the resilience of German banks is concerned, there is a welcome development. By raising new capital and retaining earnings, German banks have further increased their resilience. This is what this slide is about. This is the aggregate Tier 1 capital ratio of the German banking system, and this aggregate Tier 1 capital ratio has increased by 0.6 percentage points to now 15.6% from June 2014 to June 2015. The long-term trend towards a capital base improvement has continued unabated in 2015. Just as a reminder, in early 2008, that is, in the year of the global financial crisis, during which Lehman Brothers went bust in September, the aggregate Tier 1 capital ratio was on average 9.1%. So we've gone from that figure to 15.6% this year. The leverage ratio has also decreased, thus reinforcing a multi-annual trend. Let me clarify this by means of an example. In order to fulfill the Basel leverage ratio requirements, 8 of the major international banks, these are the banks we are going to focus on now, had to raise their aggregate Tier 1 capital by a total of less than 1 billion euros compared to the approximately 18.5 billion euros in late 2013. That is, back then, that figure would have been much higher. So this gap has been mostly closed. To build lasting resilience, banks must also achieve sustained profitability. I believe that in this area, German banks have some catching up to do, not least because of this phase of very low, even extremely low interest rates. Let's first have a look at the major German banks which operate at an international level. In relation to their total assets, these institutions have slightly improved their operating return during the last few years. Specifically, they have improved it from 1.31% in 2009 to 1.46% in 2014. Thus, during the past year, the return on total investments of the German banks has increased for the third time in a row, that is, of the major German banks. However, at just 0.2%, this return on total investment is still low compared to international levels. German banks are also lagging behind with a view to the return on equity. The return on equity of German banks still amounts to less than 5%. And that brings us to the biggest challenge for the German banking sector. The German banking sector is beset by low profitability. That is also a concern for the supervisor, because low profitability considerably limits a bank's ability to retain profit and increase capital. Quite considerably so, even. It goes without saying that this ongoing phase of low interest rates doesn't exactly contribute to overcoming the structurally low profitability of the German banking sector. Quite the contrary. In particular, credit institutions with a business model strongly dependent on interest rates, of which there are many in Germany, might seriously be endangered in the medium or long run by this persisting phase of very low interest rates. The longer interest rates remain low, the stronger the pressure on interest revenue. With a view to the present, there is, however, good news, which refers explicitly to small and medium-sized institutions in Germany. The impact of low interest rates on the profitability and stability of the German banking sector is currently limited. All in all, in 2014, the operating profit of all German banks has moderately increased, while total assets have fallen. It is now at 121.5 billion euros, and that's for all German banks for last year. If we now have a look at the aggregate net interest income, which stands for a large chunk of overall return, we see that at 90.4 billion euro, it is higher than in 2014. Back then, it was 4.1 billion euro. It was 4.1 billion euro lower. Even the savings and cooperative banks with a relatively strong dependence on the income generated by interest rates were able to further increase not only the operating profit but also the net interest income during the past year. And this is really reason to rejoice. This they achieved by expanding the lending business on the asset side of the balance sheets while shifting financing to sight deposits with low interest rates on the liability sides. Both measures, however, can lead to risks for the financial system. With a view to the lending business, we currently do not see savings and cooperative banks relaxing credit standards, thus running higher risks. That is not the threat. But at the same time, the bank's risks from interest rate changes have increased markedly since maturities in the lending business have expanded in sync with increased lending. Ever since 2011, we've noticed that the so-called Basel interest rate coefficient as a measure of risks resulting from interest rate changes has risen almost continuously, as you will be able to read in the Financial Stability Review. With a view to German banks, I believe that there are three major threats. First, the currently very good valuation results could normalize if the economic momentum weakens. So, should our economy go into a downturn, then that will actually impact the valuation results. And second, banks could be forced to correct the possibly over-optimistic forecasts for administrative expense. At the moment, the savings banks assume that the administrative expenses will remain stable, but that could change very quickly. And third, the planned increase of commission results might not be enforceable because the institutions believe that they are able to increase commission return, and that could not be the case. Thus, these three elements could additionally impact the profitability of all banks and savings banks in Germany. And seeing that we're talking about the future, we must also mention a stress test for German banks. Just to avoid confusion right from the start, we've carried out a stress test for our financial stability review on the basis of the figures available to us. The banks themselves were not involved. Hence, this stress test is not comparable to the stress test carried out within the framework of the comprehensive assessment in 2014, which was completely different. And it cannot compare to the Europe-wide stress test, which will be carried out in 2016 either. So it's our own stress test. Furthermore, the stress test in the Financial Stability Review did not take into account certain aspects, for instance, the liquidity risks of banks and, in particular, feedback loops between the banking sector and the real economy are not taken into account. Nevertheless, even our small, as I'd like to call it, stress test yielded some interesting results. We've analyzed how the concomitant occurrence of various macroeconomic shocks would impact the German banking system within the next 3 years. We subsumed a sudden spike in short-term interests and also a slump of the stock market, the real economy, and property prices. So we could say that this scenario is markedly grim. But of course, a stress test is meant to be tough. As far as the profits of German banks and savings banks are concerned, this extreme scenario would have a considerable impact. Almost half of the small and medium-sized banks and savings banks would end up with a negative pre-tax results. Let me stress that more than half of them would have a negative pre-tax result. The average annual net profit of the strongest hit banks would fall by 91%. Even the major banks would be affected. They would suffer mostly due to losses in trading operations and value adjustments in their lending business. So this would impact all banks in Germany. However, thanks to their good capitalization, and this is what I mentioned at the beginning of my presentation, none of the major institutions would fail. And considering this very extreme scenario, as I've just described it to you, this is a very good result for the German banking sector. Concluding, I can summarize everything in 4 points. The first year of European banking supervision has gone very well. Of course, there are some things which need tweaking, but we're working on that. Secondly, the reform agenda of the Basel Committee has, to a large extent, been implemented. I believe that here work will be concluded at the end of next year. The Bundesbank focuses on regulatory certainty so that banks can plan in the long term. Third, German banks have further increased their stability. Their own capital ratio has increased further, and the debt levels have decreased. Fourth, German banks suffer due to sustained low profitability. The impact of this low interest rate environment cannot be felt at the moment, but in the medium and long run, this is going to put pressure on the small and medium-sized institutions. Ladies and gentlemen, ever since the crisis, the German banking sector has become more stable. Nevertheless, it has to face major challenges like the low profitability and low interest rates, to name just two of them. And these challenges must be overcome by German banks in order to safeguard their stability and profitability. Thank you very much for your attention. Thank you, Mr. Dombret, and thank you, Ms. Buch. This brings us to our Q&A session. I would like to point out that these cameras are real cameras because there is a live stream on the internet. We've broadcast both these introductory statements and we will also broadcast your questions and the answers. Now, Börsenzeitung, Mr. Dąbrowski. Unfortunately, without a microphone, which is why your interpreter cannot hear the question. It seems to be a question concerning financing. Is financing a risk for financial stability? And what is the role of Bundesbank when it comes to the reform of real estate credits? What do you think of the fact that insurers just pay out dividends to the parent company due to the ban on the distribution of profits? What can be done against that?
Thank you. Well, first of all, the first question, the financing of criminal activities, terror activities, to put it broadly. Well, the quick answer actually would be that, well, from a regulatory point of view, that money laundering is the task of the Federal Financial Supervisory Authority. So there are regulations for money laundering and finance transactions, which is not exactly the same topic, but is linked to that. That's the task of the Bundesbank, so monitoring financial transactions. We, of course, comply with the rules, but I couldn't give you specific figures. And we haven't done this in the review as well. We haven't tried it to bring this into the context of financial stability. Now, the role of the Bundesbank, that was the second question, when it comes to real estate lending and the regulation of the real estate lending market. Well, let me look at the institutional level first of all. In Germany, we have the Committee for Financial Stability, which is the German equivalent to the European committee here. And macroprudential policy is a national task. We have European coordination mechanisms, and to a certain extent, and that doesn't affect the housing market, but with the capital-based tools, we have the opportunity at the European level to tighten national levels. So you can't soften the regulation, but you can tighten them, or the European level can tighten them. But financial stability basically is a national mandate. We, as Bundesbank, together with BaFin, the Federal Financial Supervisory Authority, we are in this Financial Stability Board. The Ministry of Finance is also present there, and we tabled a recommendation there to take macroprudential instruments for the real estate market, because we don't have this right now. So we could look at the macroprudential level, but that was a rather limited scope. In many other countries, there are regularly measures possible to look at the real value of a property and to limit it to a value that is logical in financial terms. We've presented this in the committee. It has been adopted. The recommendation can be found on the Financial Stability Board. It is now undergoing the legislation process because this just takes some time to then also implement these. The analyses behind these are coming from the Bundesbank. The analysis is to some extent based on surveys because we don't have any statistical data from the housing market. Services are very expensive for all the institutes, for us, and they also offer a certain limited view, and that is why the recommendation also specifies that a legislation should be prepared to collect the data in the residential real estate financing market, and in case that the tools should be used, a proper evaluation should also be secured to make sure that they work, and if not, that they will be modified. This recommendation doesn't specify what exactly the underlying value of a property is. I mean, there's also it is also considered to limit the debt service in relation to the income of the buyer. So right now there are no calibration effects. So we can't specify the specific values, the loan-to-value limit. Well, we can look at other European countries, but I mean, there are always national aspects to be considered, so we can't copy what other countries are doing. And then there was a third question as regard insurers, but I only noted down in parts. Well, this distribution of profits, well, we cover this in our review. And if you think about the objective of this Life Insurance Reform Act, this act wants to make sure that reserves are built up at the insurers too, that they retain reserves to be able to handle burdens in the futures. So we have to evaluate this against the backdrop. We've pointed out first that this new act has created some help because more reserves are kept, but there's still a loophole where part of the reserves are not covered, and we have to consider whether or not it makes sense to take closer regulation there. Mr. Dombret, you wanted to add?
If I'm allowed to do so, I would like to pick up your question concerning financing, or to avoid the financing of terroristic organizations. This is one of the focus topics of this year's G7 summit. We are close to the end of the year. The summit will be under German presidency, and the French mentioned this subject very early during the G7 summit. That was the case also in Dresden when the governors of the central banks met, and it has been a very important topic also against the background of the last terrorist attacks, which is why the G7 has picked up on this. So it is a topic of paramount importance. When it comes to banking supervision, this is also linked to other criminal risks. Above all, the cyber risks due to cyber attacks on banks on the internet. I would like to point out that this year cyber risks have been one of the focus topics of European banking supervision. At the beginning, we did not really think of terrorist attacks, but we thought of other kinds of attacks on institutions. And when it comes to the banking supervision itself, it's not the terror risks, but the cyber risks which are evaluated when it comes to operating risks. And the institutions are tested for their resilience when it comes to cyber risks. In the UK, there have been test runs already, and I believe that when it comes to the impact of terrorism and the financing of terrorism, this will be taken into account in the future. And this brings us now to the area that Mrs. Buch mentioned, that is the shadow banks. When it comes to fintechs, we have to be very careful how they are used so that payment flows aren't routed through banks which finance terrorism. This is a very important area. We have to analyze what is happening outside of the direct banking sector. Maybe there are possibilities to do certain things without leaving any signs and to route money into the wrong channels. We have to figure out where the financing of terrorism could play a major role. This applies especially to systemically important institutions, but then again we've got the stock exchanges and the counterparties which could also be impacted by terrorism. This is not a topic that concerns financial stability, but it's a topic that when it comes to banking supervision is taken more and more into account. Thank you very much. Next question, Mr. Otto, Zeitschrift für gesamtes Finanzwesen. Sorry, for Kreditwesen. Thank you very much. Ms. Buch, a very quick question concerning residential property instruments. Aren't you afraid that banks and also citizens feel their rights are curtailed if you now tell everyone how much of a loan can be paid out or can be received? So if you introduce a loan-to-value limit, and when it comes to the maturity insurances, which are much safer, will they be treated differently compared to banks when it comes to a limitation imposed on maturities, or do you think that they will be treated in the same way? Is it possible to treat them differently? And the second question is a question I would like to ask Mr. Dombret. We saw an image or a slide concerning the links between the various banks, and I believe that this also applies to banking supervision. If we have a look at that slide, there was a value, if I'm not mistaken, it was something like 45.7, something like that, and I would like where that figure comes from, because the links have not always boosted stability. Here we've got a value which is almost at 60%. Is that alarming or not?
Thank you. Two excellent questions which will provide me with an opportunity to explain certain aspects in greater detail. First of all, the question macroprudential tools in the real estate sector. Again, we're not saying that these instruments will be activated right now. What we're saying is that right now we see a situation where, yes, in some areas, and some of you might be personally affected by this, prices have increased strongly. There are regional price developments which we monitor, and we've done model calculations that indicate that there are excessive price gains by 10 to 20% if you look at the overvaluations, but that's not applicable to the whole of Germany. And credit volume in real estate is not increasing considerably, and we also know it from our survey, and we presented last year too. So right now there are no new insights. We've evaluated once again, so we don't see that the loan standards have eroded. In Europe, there are countries where the situation is completely different. There are stronger price increases, where private households are excessively in debt, and that might be a consumer protection topic. But the question is, when might risks arise that might affect the entire system at large? And there are situations in other countries, or there were situations where private households were so much in debt that once a risk emerges, once there are value changes, once real estate prices fall, they would have to really reduce private consumption so strongly that it would no longer affect the individual household, but have an implication for the system at large. I'm explaining this in detail to show you how far away we are from such a situation. Should, however, such a situation arise, and should we perceive a possible risk of such a situation, then we would take regulatory measures. Well, maybe our wording was slightly provocative. That would interfere with private property rights. No, in such a situation, we would make sure that the lending standards would such that they be backed with a solid financing system. So every bank, that's what I'm saying, that offers a solid real estate fund financing looks at the loan-to-value limit, and that would not be affected by such a cap. I mean, these are values that the banks themselves use when they do prudential financing. But you quite rightly address an important topic with all the measures that interfere in the contracts and conditions of contracts. Well, we have good reasons for that, because the costs of financial crises and real estate bubbles are extremely high, and someone has to bear the cost of that. And we want to alleviate the taxpayers. But with every measure we take, every regulatory measure, we always run the risk that we have side effects. And if we discuss in the political process, we might dilute aims or reach aims that were not the original objective of the regulation. That is, valuation is so important. That's a catchphrase, really, and you read it everywhere. So we have to be clear and say, okay, we have to have proper calibration. We've mentioned this before, but then we also have to look what we have achieved with the instruments, and whether we have achieved what we aimed for in the right proportion. But we want to prevent any risks, because these risks would affect everyone and would have a disaster effect on the overall economy. The interpreter apologizes. Questions without microphone can't be translated because it can't be heard. It's a different approach. I would never dare to say that everyone has to live up to their decision, and I would never say that I could take a better decision, but would have to have a macroeconomic view. And that's also part of the regulation which we've carried out. This regulation was motivated by the fact that each individual bank, they have their own business model, quite rightly so. They have their own profit situation. They focus on that. And that's exactly what the task of each and every bank is. But the system at large is something the individual bank or the individual player doesn't have, and that is why we have this additional perspective, which we have, and we have implemented this in our regulation. Now, the connection. The data you've seen comes from a database which we use very intensively and fill very intensively, and we look at the connections between banks. Can we find more about that? And that's exactly what we're focusing on. We know that connections make sense to a certain extent. It's part of a normal market economic business and process, because risks are shared, and there might also be situations where the connections is too strong, too connected to fail is the catchphrase here, and this might lead to a situation where the distress of a single bank might affect the entire system. And here again, we have to focus on risks and also look at where regulations might cause risks. But that is something we haven't detailed here. But that is why we are looking at the connections, because we want to understand where possible risks are within the system, and should these risks build up, would that affect this system at large?
Mr. Dombret? Mr. Otto, concerning your question of the various links between the banks, it is no surprise that the banks are all interconnected. This is no news, and it's not a problem either. Just a few examples. Think of the various networks between banks and the central institutions. That is important for the customers, but also for the owners. It acts as a safeguard because the banks want to reduce their risks. That is usually done in connection with other banks. And also think of the interbank business, where money is actually invested overnight because it would not make sense to invest it in the long term due to the low interest rates. So all that is not a problem. Of course, problems arise when there are too many links during a crisis that would cause a domino effect. Then there are also all the obligations concerning the central counterparties. So here we've got a link based on the definition. Nevertheless, we have to have a look at the guarantees for the various businesses. So your question also shows that we need a banking supervision. We've always had a banking supervision in the form of central banks. Now we've got a European central bank, and we also need several institutions looking after financial stability. We need an entire systemic system. So there are many links, and we just have to analyze the impact of these links.
Well, we're analyzing that exactly because we know that these aspects might lead to risks. Mr. Siebold from Reuters. Yes, one question regarding the real estate sector. One question regarding the residential real estate sector. Could you explain again to what extent the risks have evolved for financial stability? Are there sectors which you focus particularly on? Is it the private residential real estate or commercial real estate? I'd like to ask this question to Ms. Buch. And would that also affect supervision? Well, it's good that you address this question to me again, because the recommendation of the Financial Stability Board is dedicated to the private residential real estate, not to commercial real estate, for different reasons, because the financing structure and the incentive mechanisms are different, and our databases, again, is different. So we're focusing on the private residential real estate sector. Of course, we look at all the different sectors based on the data we have with private households. The situation is such. If you compare it with the situation in the US, for instance, or in countries that are affected by big real estate crises, and the debt of private households in Germany is lower, and as regards the financing of residential real estate, we have lower ratio than in the euro area. It's slightly below if you look at the average, but lower in the United States, where you see a strong decrease in the indebtedness of private households. I mean, this is the aggregated level. I mean, individual people might be more strongly affected, but that's the overall view. And our assessment is the following. We see the different indicators. We'll look at those. That is total debt, also the increase of residential real estate lending. And if you look, depending on the graph you use, and also depending on where you start, whether it's 2008, there was a strong increase in Germany, the price. But if you look at the price development, we look at this, and we have looked at it over long term, and also the development of lending standards and the lending volumes. And we clearly have to say, even those, particularly for those of you who come from a different context or from other countries, for different also historic reasons, we are in a poorer position because we just don't have access to many of the information we would need. And maybe Mr. Dombret will talk about supervision.
Thank you very much. That is a very interesting question. Mr. Dombret has just switched off his microphone. Slight technical glitch, apologies. When it comes to banking supervision, the most important aspect is with a view to the growth of lending during the last few years. That growth has been financed basically from lending to residential real estate financing. That is interesting. What the supervisory body is doing is to analyze the risk assessment models, that is, whether a bank has the right model to judge the risk involved in lending money to a certain creditor. We have to be particularly careful when there is such marked growth in residential real estate. That was relatively loud. So, due to low interest rates, there are also many long-term real estate loans with a maturity of 20-25 years. The banks have not really financed that fully. You know, when you add a low rate loan in your balance sheet, then in 10-15 years it will still be a low interest rate loan, while the market situation might have changed completely. People buying real estate these days might not be able to pay the down payments if the economy goes into a downswing, a downturn, and the situation on the labor market deteriorates. Also, there is a discrepancy between real estate prices at a national level. In the large conglomeration areas, real estate prices have grown much stronger compared to other areas, and this also concerns the surroundings of these conglomeration areas. Ms. Buch said that the risk of bubble formation isn't that strong. Lending in itself has not increased so strongly to actually threaten the formation of a bubble. In front of the cameras it might not be very practical, but seeing that I don't have the exact figures, I'd like to guess the importance of real estate financing. Real estate accounts for a very large part of the exposure of private households, even to 80-90%, and it also accounts for 40% of the lending volume of banks. When it comes to savings banks and cooperative banks, it's a percentage of about 50%, and that tells you how important real estate is in the balance sheets of banks. So you need to have a close look if you're a banking supervisor. Now, the next question from Ms. Schreiber, Süddeutsche Zeitung. The microphone for Ms. Schreiber, please.
Thank you. 3 questions. Mr. Dombret, 2 directed to you in particular. You were rather skeptical that the German banks can increase their fees. Can you explain why that is the case? And then you also voiced your concerns that fintechs might be used for funding of terrorism. Fintechs are also subject to money laundering regulations. Could you expatiate on that, and also the connection of German banks or amongst German banks? Are there comparative values from the past, or is it the first time that you've covered this?
Thank you very much for those questions, Ms. Schreiber. You talked about an increase of fees, commission fees. In my answer, I would have to consider the timeline. Of course, increasing the commission fees is achievable and is even recommendable, so that you are less dependent on interest income. It's something that most banks and savings banks are actually aiming at, and very strongly so. When we talk about commissions, this includes the normal banking fees too. During our survey, about the impact of low interest rates, which you might already know from previous press conferences. We actually polled most German institutions, about 1,500 of them, and most of them said that they had already increased their fees, and those who hadn't done so said that they would do so in the immediate future. So they are aiming at increasing their commission business. That means that they have to invest in things like the training of their employees, and despite the strong competition in the German market, they must find arguments to take that commission away from other institutions, from competitors. That doesn't happen overnight, it takes some time. So the revenue from commission needs to be increased, that's the goal, but it cannot be done overnight, it cannot be done in a short period of time. We talk to all institutions, as you know, and all institutions tell us that they want to increase their commission business. Not all of them will succeed in the same way, so they're all doing the same thing and are going through the same door, as it were, and the door isn't large enough to accommodate entrance for everyone at the same time. But of course, this is something that is highly recommendable when it comes to stability. You also mentioned fintechs. It's a topic I don't really like to deal with that intensively, but I've heard that when payment streams for the financing of terrorism are analyzed, we see that they usually sent through a digital system, not just fintechs, but also apps. And sometimes this regards institutions which aren't domiciled in Germany. So it's relatively difficult to monitor all that. But I know that those who deal with this, Ms. Buch already mentioned that we don't, that is, those who deal with consumer protection and money laundering, find electronic money transfers more and more important. The reason being that, how can I put it? Maybe it would suffice to say that these new digital transaction systems allow terrorists to transfer money anonymously, and that needs to be monitored very closely to counteract terrorism. Now the last question. Do we still have one open question? Yes.
Yes, exactly. That was the question, that the connection, how does this change over time? I'd like to give an outlook, well, first of all, to the national German market, and then also look at the international dimension. The specific data point, as you've called it, I can only offer you a summary. I mean, I cannot show a graph showing how this has evolved over time, but we do other network analyses internally. We look at how the network structure changes, which isn't that easy because you have to really delve into the intrabank markets and all the nitty-gritty of that. But what you see here is that the central hubs of networks are fairly stable also over time, because behind those are specific business models. Mr. Dombret has mentioned the associations. There are contractual links between all the participants of these associations. That's also reflected in the financial relations. That has a stabilizing effect, but with every network you have to ask about what are the stabilizing and what are the destabilizing effects. So many of these effects are driven by the business models and the structures, and we have to just look for regulatory incentives and disincentives. At the international level, the situation is such, and we discussed this in greater detail, that is why we had the initiative Banking Union and Capital Markets Union. We see a stronger fragmentation of the finance markets, also due to the crisis. The question here is stabilizing, destabilizing. We did the analysis of, we have a network of different Feds or different state banks who look at this, and those banks who are very locally active are less affected by international shocks because they have a local finance base. But those banks that are active internationally and their internal capital market can protect them against shocks. So we will never have just one single answer to this connectedness. So there's a kind of interplay between the business models and the actual economic risks behind them, and also the regulation here.
There are 6 people who have asked to pose a question. Now, the next speaker, Mr. Krohn, FAZ. Ms. Buch, I would like to ask a question concerning 2 aspects. One is the consistency of regulations and also old age provision. We had the Riester laws that were introduced in 2006, which aimed at providing people with lifelong pension payments. So that led to a higher number of liabilities within the balance sheets of insurers. And we also have sovereign bonds, which have a very low return these days. Are the regulatory goals and also the legislative goals actually in sync with each other? We've seen that large market actors have withdrawn from the business of life insurance and offer new solutions. This begs the question what kind of future you see for collective old age provision in Germany.
Well, a very comprehensive question. I don't know if I'm really the right person to give statements on the German pension scheme and all the aspects you've mentioned. I mean, it depends on how we want to secure our pensions. I mean, we can only cover part of the problems you have addressed. What we point out, however, is yes, it's exactly what you point out. The insurers were subject to the different combinations of different options, so they play a specific role because they have long-term liabilities. That's nothing new. And then the question arises, to what extent should the assets be in sync or the investments be in sync? And that's a typical investment model for insurers. So maybe they should have an appropriate model. And the problem right now is that the long-term investment opportunities offer very low interests. And that's nothing we can change from a regulatory point of view. That's exactly what I have addressed. So this reflects the overall economy. So these are exogenous framework conditions, also the changes in the interest rate curve, but this is reflected in the balance sheets of insurers and banks. That is why we pointed out 2 specific aspects. The life insurers, we have to look at the hidden burdens and the hidden reserves hidden in the balance sheets, and we have to make sure, and the legislator has done it, that the reserves are adequate and that adequate reserves remain in the balance sheets. And the extreme scenario, which we have described, but I mean, from a financial stability view, we have to look at extreme scenarios too. The second aspect then is, and this was changed in regulation in the past, so you can get your policy paid out, and this might be interesting if there is a turnaround in the interest structure and if you have a revaluation on the asset side and the liabilities cannot be adapted accordingly. And we say this has to be changed in terms of regulation. And for new contracts, maybe that is something that has to be adapted. But let me be rather general. I mean, I've pointed out that we have a longer period of time we're talking about, and these risk scenarios might evolve over a longer period. I mean, insurers have the opportunities to adapt, but that's not our task to tell them how to do it. We can point out certain risks, but then we said it also in other questions, it's the role of the market participants to find a proper solution. We're not the one to propose a business model to them. The next question, Mr. Baumgartner from Frankfurter Neue Presse. No, in the front row, please.
I have a question for both of you. Ms. Buch, you talked about the banking and capital markets union to distribute risks, and Mr. Dombret seemed quite skeptical of that, especially when it comes to the deposit guarantee system. And you also talked about some companies or some banks which could run up against risks in your scenario. If I'm not mistaken, 7 would run a great risk out of 86 or 7 insurance companies. And I would like to hear a little more about that, if you don't mind. Let me start with the first question, that is the distribution of risks. You seem to have read into that there is a contradiction in terms, but actually there is no contradiction, because we talked about slightly different things. When it comes to the capital markets union, the salient point is to ask where within the financial system there are risks and how different financing structures impact the way we deal with risks. I believe that this point is almost trivial, because we said, okay, if you use leverage for financing purposes, then you don't have certain repayment obligations which can cause problems when there is a deterioration of the general economic situation. This is also reflected in the financing structures of companies where different ways of financing are combined with each other. So the question is whether there are now distortions within the system where more leverage is used instead of own capital for financing purposes. We see that in emerging markets where there is a strong financing activity based on debt, on leverage capital, and we believe that this could increase risk. So in a very generic way, I would say that we have to think about financing structures, and the capital union is a very important project within this context. And then you talked about deposits. That's the third pillar of banking union. This refers specifically to whether, seeing that we've got European banking supervision, we should also introduce deposit guarantees at a European level. We have to ask ourselves where the risks arise and why they arise. And we also have to think about how we can share these risks. So first and foremost, we have to think about where risks could arise in order to define measures to counteract those risks. And at the end of a long process, we could then introduce a deposit guarantee system, but we're not there yet. We still have a mostly national system. So at the beginning, we need to talk and think about the preconditions for such a system. If you want to see it in a very generic way, then you have to focus on the distribution of risks and how these risks can be counteracted. So these are two sides of the same medal. And Mr. Buch says Mr. Dombret is right, there is no contradiction. As far as the deposit guarantee system as a plan tabled by the EU Commission during yesterday's meeting is concerned, I tried to point out that I'm not against a Europeanization of these measures. They have my support. If you link capital markets union and deposit guarantee, then that can be done only at a union level, and Deutsche Bundesbank is very positive when it comes to this. we were in favor of a single banking supervision system, and these aspects also apply to the deposit guarantee system. And we also have to say that if we don't have, we don't have immediate implementation of all these activities at a European level, then that's not because of the ECB, but because of our politics in Germany. And BaFin, the Federal Financial Supervisory Authority, will continue its work. I believe that with your question, now the comment was off mic, I, fundamentally speaking, don't comment upon the work of individual institutes or agencies. But it's part of a group. That institute or agency is within the group of a significant bank, and thus it is under the supervision of the ECB because it is subject to group supervision. But if you wait too long, then, if the shoe fits, then you'll have to wear it in the end. So we can't just blame the ECB for everything. And when it comes to the licenses or the fees paid to supervisory board members and branch managers, I have to say that the single supervisory mechanism, SSM, has had to deal with more than 1,500 such motions within the first year of its existence. The board of the ECB also has to pronounce itself on these motions, and I believe that all these branch manager licenses have been accepted very quickly and in a very practical way. That is what I said at the beginning of my presentation, that we have to do certain things more routinely. Now, Ms. Schäffler, Stuttgarter Zeitung.
Well, one question as regards the financing of terrorism. Mr. Dombret, sorry about that. I'm slightly confused. This digital network, can you be more specific about that? Do you talk about, in general terms, about bitcoins or paper handy or mobile or PayPal? I mean, we're all familiar with that. So your answer was too general. I'm talking about bitcoins. That was a quick answer. And now, Mr. Sunaga from Jiu-Jitsu Press.
Ja, vielen Dank.
Thank you very much. I would like to ask a question concerning the politics of the policies of the ECB. Do you believe that ongoing low interest rates are really a danger for financial stability? And if so, are there any measures which are currently under revision to fight inflation? Will there be an impact on financial stability in Germany due to these measures, and maybe also at a European level?
I hope you will bear with me that I'm not giving into speculations as regard next week's decision. Let me give you a rather general answer. Well, interest rate developments are of great relevance also for financial stability. And we have in-house analyses focusing on different interest rate developments and how that would impact on banks and what have you. And of course, we have a very strong structural rupture because the financial markets have adapted to new regulations. So it's important to focus what Mr. Dombret has expatiated on detail. We looked at the insurers. We just need to have sufficient resilience within the system in case of macroeconomic developments that might affect or impact the banks. I'd like to leave it at this general remark because I won't forecast the future. And a little addition here, the terminology used to, if you bear with me, Mr. Weidmann, the president of the Bundesbank, who also sits in the ECB Council, keeps repeating that there is no deflation and no deflation risk. We have low inflation rates right now. Above all, the headline inflation is low, but there is no deflation in Europe. This just by way of clarification. Now I'd like to hand the floor to Mr. Plickert to ask the next question.
The microphone does not seem to be working. Apologies from your interpreter. The question is off mic. Apologies from your interpreter. Your interpreter hopes he will be able to infer the question from the answer.
Well, the figures sound similar because in the past years we said it's not enough to look at price increases. You have to try and get a feeling what's demand driven, what's supply driven, and our models, as I've just said, supply similar values as regards possible overvaluations. But you always have to take it with a pinch of salt. I mean, these are statistical values. They show a certain bandwidth, and the big factor which we have to integrate into our models in the future, but it's also it also has a lot of uncertainty. That's the migration, and the migration levels are not specific. And what does that mean for house building? So we have to try and work what we have right now, and that doesn't show or indicate any strengthening or any increasing of risks here. But we try to use all the information we have as regards the real estate market and put it on our homepage as soon as possible. It's a situation we have to make do with a situation that we don't have reliable timelines here. We're working on that, and we're also working on the analyses, so we're working on it. Yes. There are no further requests for the floor, and with that I'd like to say thank you for your attention and have a nice day.